This is Mike Swanson. I run the website WallStreetWindow.com. They want to give you a update on what I see going on in the markets. Usually I do a post or a video almost every single trading day, but I didn't do that last week. The last update I have done was the previous Sunday, a week ago from this one. And that's because, frankly, I wasn't expecting really anything important to change in the markets at all. And in some ways, that is still the case. But let's take a look at the charts and see where things stand now. On Thursday, the S&P 500 had a tremendous daily rally, and the Dow was up over 800 points. In fact, from the low of the morning, it had a big gap down on Thursday. And from that low to the closing high was the biggest daily gain in 2 years for the stock market. And that brought, of course, a lot of excitement, hope on the close that, look, maybe, the bottom is in. But how many times have we seen that this year? As I said in the video last week, there was a rally on the Monday and Tuesday 2 weeks ago that caused the same excitement. And on Twitter, I saw gurus claiming the Fed's going to pivot, the Fed's going to pivot. And then, what's happened, that was proven to be wrong. And that rally fell apart, just as the Thursday rally has already been sold into. We're in a real bear market, and it's been going on since New Year's. And I don't think it's going to end. And I've said this in videos and in posts. I don't see an end of this bear market till next year because we're in a cycle in which the stock market, will lead what's going on in the economy, and the economy is slowing down. We're seeing signs of that, for example, in the real estate market. And there's no reason to think that this is not going to stop until we see the end of this interest rate hiking cycle. And the bond market does not see an end to that till the spring of next year, despite the claims of pivot talk. It's all a hoax. These same people are telling you that in June and July, and the market rallied. And look, this is the Fed fund futures. They're now projecting a 97% chance of a 3-point interest rate hike in November. Fed pivot talk proven to be a hoax by this fact. And now they're projecting that interest rates are going to get basically likely above 5% next year, maybe 5.25%, possibility of 5.50. So the pace of the rate hikes is even now bigger, projected to be bigger than it was just 3 weeks ago. So the interest and look, a key thing to be watching for is this is TLT, the bond ETF, and it closed on a 52-week low on Friday. It did not confirm the Thursday rally at all. So what we saw was what you see in bear markets, wonder rallies. If you look at stock market history, the biggest one-day rallies in the market have been during bear markets. There are many moves like we saw on Thursday in 2008. And in 2000, similar swings. So that's where things stand. Nothing has changed this week. Now we have earnings coming out. Netflix reports earnings. There's other high-profile earnings companies earnings reports coming out this week and the next 3 weeks. My expectation is that we will see more intraday swings in the market of size, and we may be in a trading range here of the high of 3,700, let's say, on the S&P 500, set the last 2 days, and 3,500 as a low. We could have that as a range for the next couple of weeks, but I think we're going to see a lows below 3,500 before the end of this year. We're going to see tax loss selling before this year is over. and that's going to weigh on the market too. Now, what has been a bear market in January has now spread into other asset classes that have been doing well up until now. For example, this is the GCC commodity ETF, a broad-based commodity ETF. It did much better than the stock market in the first quarter, but it peaked out, and it's now been in a correction too. I think in the next 10 years, I think the commodities are going to outperform the stock market, but commodities have been falling with the market. Since June, really. Now, something I believe is a great long-term investment too for the next 10 years is gold and silver. But gold and silver have been pulling back too with the stock market. However, I want to point out to you on the bottom of this chart is the gold divided by S&P 500 ratio. That creates a relative strength plot. And when that goes up, it means the price of gold is outperforming the price action of the S&P 500. And it's been doing that all year. And even in the past month, as you can see, it's been going up, even though gold has gone down. And gold took a hit last week, but the ratio did not take a hit. And I expect gold is going to bottom out before the stock market bottoms out. Before the stock market bear market ends, gold will bottom first and break away from the action of the stock market and begin a tremendous rally, probably a new cyclical bull market. So I do own gold, but I plan on buying more at some point. Probably, not next week, probably not next month, but I'm watching this closely. Silver is the same story, in mining stocks too. So I think that's going to be the first place to look for buying. Now, what you want to be really careful about in this market, though, is to avoid sectors that are underperforming the stock market averages. So this is the SMH ETF. It tracks semiconductor stocks. And you can see I have a relative strength plot on that. It made a new low for the year on Friday, underperforming the stock market, and it's likely to continue to do so. Sectors and stocks underperforming the stock market are leading the market down, are going to fall more than the market. They are places where people are going to lose a lot of money and need have high risk, low return. Stocks such as NVIDIA are in this situation. Stocks such as Meta, Facebook are disasters. Stocks, let's say, as Coinbase, underperforming the stock market, dead relative strength plot. What's another one? I think Norwegian Cruise Lines underperforming the stock market. There's a lot of stocks doing this. Best to be avoided. So that's where things stand now in the stock market as we look at things over this weekend. Again, one piece of advice I had last week was to be very careful about getting caught up, provoked into doing something because the market has one big up day. That's not enough reason to buy. It's not enough reason to think that the bear market is over. We saw that 2 weeks ago. We saw that on Thursday. And to avoid that trap, I think perhaps what you may want to do, it's what I'm doing, is to not look at the hourly action, not pay much attention to the daily swings. Just analyze things every couple of days or every weekend until we see true signs that we're at the end of the bear market, because one-day rallies mean absolutely nothing. 2 or 3 day rallies really don't mean much either. This is a real bear market, no sign that it's over, and I don't think it's going to change this week, this month, next month either. but I do continue to look at things every week, just not every hour, not every day. And that might be something you may want to consider doing. Look, the financial media, I'll just all of it, has to put out content every single day to maintain its viewers and gain new ones, whether it's a person on YouTube or CNBC or a Twitter person. They have to continue to put out content. And that means responding to daily gyrations, daily news, and extrapolating from that. When in reality, most of this stuff is simply noise that is best to be ignored until something really changes. And that's how it is. So look, if you want to get my next video from YouTube, if you're new to my stuff, hit the subscribe button and then hit the bell next to it, and YouTube will send you an alert as soon as it's up for you to watch. And I'll be talking with you later.